It is Thursday, January 29, 2026. You are plugged into the deep dive. Today we are looking at a company that has been around for, what, over a century? A company that for a long time was really the only game in town. We were talking about IBM.
Big Blue, the original tech giant.
Exactly. And, usually when people talk about legacy tech, it's sort of a polite way of saying obsolete, right? Think of big, dusty mainframes and technology that peaked in the 1990s. But we have the Q4 2025 earnings report that dropped yesterday, the transcript, the slide deck, and frankly, the narrative has shifted.
It definitely has. I mean, if you haven't looked at IBM in a few years, you might not recognize the company. They are generating a level of cash right now that is honestly eye-watering.
It really is. So our mission for this deep dive is to cut through the noise. We need to figure out how they generated $14.7 billion in free cash flow, why their AI business is booming in a way that is, totally different from Microsoft or Google.
And the mainframe part.
And this is the part that surprised me the most. Why the mainframe is having this massive AI-driven resurgence.
Yeah, it's a classic turnaround story, but with a very, very modern twist. And it's not just about cost-cutting, it's about a fundamental pivot in what the company actually is.
So let's start with the headline numbers. Full year 2025, IBM delivered 6% revenue growth, hitting $67.5 billion. Now, I have to play devil's advocate here. In a world where we see AI startups growing, 50, 60, 100%, 6% feels steady.
Yeah, steady.
Is it actually impressive?
Context is everything here. You can't compare a $67 billion infrastructure giant to a nimble startup. 6% at the scale is billions of dollars in new money.
Okay.
It proves they aren't shrinking, which was the fear for a long time. But the revenue number isn't actually the most important metric. You have to look at the cash. You mentioned that $14.7 billion in free cash flow.
Right. That number jumped right off the page for me.
That is up nearly $2 billion year over year. It's the highest cash generation they've posted in, I think, over a decade.
Wow.
And for a mature company, cash is everything. It funds dividends, it funds acquisitions, R&D. It just validates the strategy CEO Arvind Krishna has been hammering on for years. He's stopped calling IBM a hardware company.
Right. He has that new phrase.
He calls it a software-led hybrid cloud and AI platform company.
That's a mouthful. But is it just, marketing fluff? Or does the balance sheet actually back that up?
Well, the numbers say it isn't fluff. If you look at the revenue mix, software now represents roughly 45% of their entire business.
45%.
Yeah. And back in 2018, that was only about 25%. I mean, that is a massive identity shift for a company this size. It's so hard to steer a ship that big, but they've done it.
So nearly half the company is now software. That's got to be why the margins are expanding, I assume.
Precisely. Software margins are just juicier than hardware. And that software segment isn't stagnant. It grew 9% for the full year, the highest annual growth rate in their history for software.
In their history.
And in Q4 specifically, it accelerated to 11%. So the growth engine is actually, working.
Okay, so if software is the engine, what are the pistons? What exactly are they selling? Because I definitely don't have IBM word processor on my laptop anymore.
No, you don't. It's all B2B infrastructure stuff. It's the plumbing of the internet and the enterprise. In Q4, data software was up 19%. Automation was up 14%.
Okay.
And Red Hat, which is their open source cloud arm, was up 8%.
I want to touch on that automation piece because the CFO, Jim Kavanaugh, mentioned this idea of a flywheel for growth.
Yeah.
And usually, when executives say flywheel, my eyes kind of glaze over.
It's buzzword soup.
It is.
Oh.
But he laid out a pretty specific logic trail here.
It is logical. The argument is that client trust is the entry point because IBM has been running banks, airlines, healthcare for decades. They trust them.
Right.
That trust leads to the client adopting IBM's hybrid cloud platform. Then they need software. Then they need automation. And that creates recurring revenue, which funds more R&D, which creates better products.
So it starts with, we trust you not to lose our money, and ends with, we run our entire AI stack on your software.
Exactly. And that brings us squarely to the topic everyone is waiting for, AI.
Yes. For the last 2 years, every earnings call has just been a game of how many times a CEO can say generative AI.
Yeah.
But does IBM actually have real traction here?
They have real numbers, but the shape of the money is different than what you see with, say, AWS or Google.
Hmm.
IBM's cumulative Gen AI book of business has now surpassed $12.5 billion.
12.5 billion is substantial. But define book of business for us. That's not recognized revenue yet, is it?
Right. It's signed contracts, orders, it's the pipeline, the future revenue. But here's the really interesting part. Look at the split. Of that $12.5 billion, over $10.5 billion is sitting in consulting.
Consulting. So companies aren't just buying an AI product. They're paying IBM to come in and figure out how to use it.
Exactly. And if you think about the enterprise market, that makes perfect sense. I mean, imagine you are a massive Fortune 500. You've got petabytes of messy data, ancient legacy systems, PDFs from 1995, and a terrifyingly strict compliance department. You can't just plug into a public chatbot and hope for the best.
That sounds like a complete nightmare.
It is. They don't just need a chatbot, they need a strategy. They need someone to design the architecture, clean the data, govern the access, all without getting sued. That's why IBM Consulting is winning.
So IBM sells the advice, the how-to, and then presumably that pulls through the software sales later.
That's the theory. And we are seeing it start to happen. The software portion of that AI book of business is catching up. It's now over $2 billion.
Oh, okay.
So the consulting leads the charge, and the software follows right behind.
Speaking of using AI, there was this one detail in the transcript that I actually highlighted. It felt so human. They mentioned an internal project called Project Bob.
Yes, Project...
I just love that they named their cutting-edge AI system Bob. It sounds like an accountant from mid-management who brings donuts on Fridays.
It does, doesn't it? But Bob is actually their Client Zero showcase. It's IBM's internal AI system for their own developers.
Eating their own cooking.
Exactly. And they're using their own tools, orchestrating different models, some from Anthropic, some of their own Granite models, to help their own people write code.
So how well does it work?
The stats are wild. They said 20,000 IDMers are using it, and they're reporting productivity gains averaging 45%.
45%. That's nearly cutting the workload in half. That seems incredibly high.
It's massive. And think about that as a sales pitch. When an IBM consultant walks into a meeting, they don't just say AI is the future. They say, look, we use this to make our own coders 45% faster. We have the data. Do you want the same results?
It changes the conversation from AI is a toy to AI is money.
It moves it strictly to ROI, return on investment.
Right.
And that connects to a broader trend they mentioned. We are moving past the funny chatbot phase.
Yep.
The experimentation phase is ending.
Yep.
Now clients are asking, how do I deploy this across my entire supply chain? How do I govern this? And that's where IBM Consulting thrives, because that stuff is hard.
Okay, so software is booming, consulting is riding the AI wave, but then I looked at the infrastructure segment, the hardware, and honestly, I expected this to be the shrinking part of the business. I mean, the narrative for 10 years has been everything goes to the cloud.
You think so? It feels like buying a DVD player in the age of streaming.
Exactly. But infrastructure grew 17% in Q4, and IBM Z, the mainframe revenue, was up 61%. 61% growth for a technology that people have been predicting the death of since the 90s. What is driving that?
The mainframe strikes back. This is the Z17 cycle, and it's not just about people needing more storage. The Z17 was designed specifically for real-time AI inferencing.
Okay, let's unpack that. Real-time inferencing. Why do you need a mainframe for that? Why not just use the cloud?
Latency in physics? Think about a credit card transaction. You're at the store, you tap your card. That authorization has to happen in milliseconds. If the bank wants to run an AI model to check for fraud on that transaction, they cannot afford to send that data halfway across the world to a data center, wait, and send the answer back.
Because that takes seconds. And I'm just standing there looking at the card reader waiting for the beep.
Exactly. You have milliseconds. You need the brain to be sitting right next to the transaction data.
So the Z17 does the AI thinking right there on the box.
Right on the chip. They have these things called Spire cards, basically AI accelerator chips that plug directly into the mainframe. It lets them do AI in line with the transaction, no delay.
So it's about speed.
Speed and sovereignty.
That word sovereignty came up a lot in the transcript. It sounds almost geopolitical.
It is becoming a huge theme, especially in Europe and Asia. Governments, regulated industries, they want on-premise control. They have privacy regulations that say this patient data cannot leave this building.
So they can't set it to a public cloud.
Exactly. They don't want their sensitive customer data going to a hyperscaler's public cloud where they don't control the hardware. Sovereignty just means control.
I own the box, I own the data, I know exactly where it is.
Exactly. And for high-volume transactions, doing it on your own metal is actually cheaper. The executives noted that for these heavy workloads, the mainframe is actually the lowest unit cost option.
Really?
Yeah, if you tried to run that kind of volume on the public cloud, the bill would be astronomical. So you have this perfect storm: speed, privacy, and economics. That's why the mainframe is booming.
It's fascinating. The old tech is the only thing capable of handling the new tech for these specific industries.
And that infrastructure profit margin is huge. It provides the cash cushion that funds the rest of the software transition.
Okay, let's talk about the other side of the cloud coin. Red Hat. IBM bought them for, what, $34 billion a few years ago?
A huge sum, yeah.
How's that investment holding up?
It's been a growth engine. Revenue has doubled since the acquisition. They're now at a run rate of around 7.5 to 8 billion. OpenShift, which is their platform for managing containers, the plumbing of modern software, is growing 30%.
30% is solid. That's definitely growth territory. But in the spirit of a balanced deep dive, we have to look at the negatives. There was a wobble in the report regarding Red Hat bookings.
Yes, bookings were only in the single digits for Q4. That was the one blemish analysts pointed out.
What caused that slowdown?
The primary reason given was the U.S. federal government. There were delays in deal activity related to, government shutdown dynamics. When the government pauses spending, big software contracts get pushed.
So IBM's stance is that the money isn't lost, just delayed.
Correct. They see it as a timing issue, not a product issue. But there is another hardware headwind worth mentioning: memory prices.
Ah, the supply chain again.
Not quite. Specifically, DRAM standard computer memory. They noted that spot memory prices are 6 times higher than last year.
6 times. That is enormous. Why?
Because of the AI boom. All the manufacturing capacity is moving to HBM high bandwidth memory. That's the expensive specialized memory you need for those NVIDIA AI chips.
I see.
Because the factories are retooling to make HBM to chase the AI gold rush, there's a shortage of standard DRAM.
So the AI gold rush is actually making basic computing more expensive for everyone else.
Exactly. If you want to build a standard server, it costs more today. IBM thinks this is manageable, but it's an inflationary pressure they have to watch.
That is a great insight. Okay, let's look forward. They're not just sitting on this cash, they're buying companies. They mentioned a big one that's pending, Confluent.
Great. Confluent. This is a big bet expected to close mid-2026. Confluent is all about data streaming.
For the non-technical listener, what does data streaming actually mean? Is it like Netflix for data?
In a way, yeah. Think of it as the central nervous system for an enterprise. In the old days, you'd save data in a database, let it sit there. That's data at rest. Confluent lets you handle data in motion. If you are going to have AI agents running around your company making decisions, they need real-time data. They can't be looking at yesterday's report.
So Confluent connects the plumbing, so the AI agents know what's happening now.
Precisely. Now, financially, buying Confluent is going to hurt a little in the short term. IBM expects about $600 million in dilution in 2026.
So they are taking a hit now for future growth.
Correct. But they project it will be profitable within the first full year. And their previous acquisition, HashiCorp, just had a record bookings quarter. So their track record on integrating these is actually pretty good lately.
So looking at the guidance for the rest of 2026, what are they promising?
Steady, reliable growth. They are projecting revenue growth of 5% or more, and they expect to grow free cash flow by another $1 billion.
How do they squeeze out another $1 billion?
Productivity. They are relentless. They plan to find another $1 billion in savings in 2026. That brings their annual run rate of savings to $5.5 billion.
Is that just code for layoffs?
Often, yes, or attrition, but they frame it as using AI to do their own work faster, like Project Bob. If your coders are 45% faster, you don't need to hire as many new developers.
Which is the holy grail for any business. Grow the top line without growing the expenses.
Exactly.
So pulling this all together, we have a company that has successfully shifted its mix. They're using their consulting arm to push their software stack. And their old school mainframe business is providing the cash to fund the whole thing.
That's the perfect synthesis. It's a 3-legged stool: software, consulting, infrastructure, and right now, all 3 legs are steady.
For our listener who is trying to make sense of where enterprise tech is going, what's the one big takeaway here?
I think the key concept is what Arvind Krishna calls the and world.
The and world.
Yes. For a long time, the narrative was binary. It was public cloud versus private data center, old versus new. The IBM thesis is that it's not or, it's and. Clients will use public cloud and private mainframes. They'll use open source models and proprietary models. IBM is positioning itself to be the layer that manages the and.
That makes a lot of sense. You don't have to pick a winner if you are the platform that connects them all. You just sell the glue.
Exactly. You monetize the complexity. And this leads to a really provocative thought.
Okay, hit me with it.
Arvind Krishna made a prediction. He said that in 3 to 5 years, 50% of enterprise AI usage will be in private clouds or on-premise data centers, what they call sovereign AI.
50%. That is a massive contrarian take. You'd think everything is moving to the public cloud.
Right. But if he's right, it means the current market obsession with just the hyperscalers might be missing half the picture. If half the AI workload stays on-prem because of privacy, sovereignty, and cost, then the company that owns that on-prem infrastructure is sitting on a goldmine.
That is a fascinating thought to leave us with. Are we underestimating the return to the private data center? We'll have to watch the numbers. IBM, cash-rich, software-led, and betting big on a hybrid future. That's it for this deep dive. Keep digging.
And keep questioning the assumptions.
We'll see you in the next one.